Every fiat currency ever devised by mankind has gone to zero. But gold and silver never have. I don't believe they ever will. So it would be pretty foolish to think that gold and silver aren't going to remain money in the future because they have history on their side.
Please join us for our next live stream Sunday, January 30th at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, January 30th, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. As always, if you are new to our channel, please do subscribe, hit that bell to be notified on new updates, and give us a thumbs up if you like what we do. We really do appreciate your support. Rob Kirby joins us once again today. Rob worked on an institutional trading desk, an international interdealer broker of foreign exchange and interest rate products, a money bond broker called Freedom Bond Brokers, which has subsequently been bought out by Cantor Fitzgerald and then Garvin Incorporated. He started writing back in 1997 and was involved in a number of entrepreneurial pursuits, including the familiar Kirby Analytics newsletter and writing a book titled From a Gold Bug's Point of View about the Markets. And we're delighted to have Rob join us once again today. It's time to saddle up and silver up for Rob Kirby. Rob, welcome back to SBTV. How are you doing?
I'm doing fine, and pleasure to see your happy smile again, Patrick.
Glad to see you. Also glad to see your happy smile as well, Rob. Appreciate you giving us the time again. You know, Rob, I want to start off with the bond market. We've seen some recent moves in it, and one of them being the 10-year moving up to roughly 1.9%. And since the start of 22, it's moved up about some 40 basis points. Why, in your opinion, are we seeing these yields going up?
Well, because the amount of money that's being printed is much, much bigger than what is acknowledged. The issue of how much money is being printed is a real bugaboo with me, Patrick. I speak a lot in my materials that I cover. I speak a lot about the Exchange Stabilization Fund, and I'm a strong advocate and follower of the work of Catherine Austin Fitts and Dr. Mark Skidmore. And Dr. Skidmore has in his travails, he has documented the movement of funds under the Social Security Trust Administration, which has roughly $400 billion in investable assets. These are retirement assets. And in the latest round of Dr. Skidmore's work, he's identified that this $400 billion in assets, which are chiefly managed by a company that you might have heard of called Blackrock, this $400 billion in assets had a turnover in a calendar year, the latest calendar year that information was available for. This $400 billion turned over to the tune of in excess of $44 trillion in 1 year. And that is a big red flag to me that says fraud. Like, any way you slice it or dice it, there's something very unnatural occurring when $400 billion in investment assets are turned over in one calendar year to the tune of in excess of $44 trillion. Your question was about the bond market. What I'm really saying here is that the amount of money that's truly in existence dwarfs what people believe is in existence, or that, for instance, what's reflected by the Federal Reserve's balance sheet, which is normally a good marker for, or a lot of people point to the Fed's balance sheet and say, okay, like in 2020, the Fed's balance sheet was 3 and change trillion. Today, it's 8.8 trillion. They've added to their balance sheet 5 trillion plus in 18 months? That sounds absurd, and it sounds like a crazy number. But the reality is, the number's probably many times that. So the amount of money that's been created probably isn't 5 trillion in 18 months. I reckon the amount that might have been created, it might be 80 trillion. And you see, to get your head around the nature of our money and money growth, you need to look at the work of Dr. Chris Martenson. And here's the thing. A lot of people will refer to me, or people like me, as a conspiracy theorist, and somebody who's out there. Like, all I'm doing is citing the work of PhD economists and PhD statisticians and people who really know what they're talking about. And like Dr. Chris Martenson did something back in 2009. He produced a body of work. It's called The Crash Course. I don't know if you've ever personally watched The Crash Course, but if you haven't, I suggest you do. And what Chris Martenson laid out in The Crash Course was the nature of compounding and what compounding does. And you see, when you're talking about bonds, it's very interesting to have the discussion about compounding, because to get your head around how money must grow in a compound interest environment, Chris Martenson does this metaphor. I guess call it a metaphorical explanation. He says if you think of look, if you think of Yankee Stadium, most people can visualize Yankee Stadium. It's a big place with stands that go around and encircle a baseball diamond, and it's got a huge volume. And he says if you take a drop of water and you put it at second base in Yankee Stadium, and if you double the amount of water every minute, starting with one drop, if you double the amount of water every minute, how long does it take before Yankee Stadium is overflowing? Now, I don't know if anyone's ever asked you that question, but how many minutes do you think it would take before Yankee Stadium was full if you started with a drop and doubled it every minute? How long before the stadium is overflowing? Well, it takes about 44 minutes, and the stadium is overflowing. So 44 doublings, and the water would be overflowing the highest point in the stands. But the interesting thing about it, Patrick, is 44 minutes to make the stadium overflow, but at the 40th minute, the water would only be up to the ankles of the guy standing on third base. So the action all happens in the last 4 minutes. Now, in a monetary sense, Patrick, we're in the last 4 minutes now. And the amount of money that's being created to keep our system going, and that's the magic of inflation. You see, people are tricked into believing that everything's under control because interest rates have been driven down to zero, effectively zero. Now, you spoke of 1.9 as in a big move up in the 10-year bond in recent weeks. And I'm saying that the amount of money that's being created absolutely makes nonsense of the whole idea that we have interest rates at 1.9 or 1.3. I mean, what's the difference in a 10-year bond between 1.9 and 1.3? I mean, the difference is 60 basis points between 1.9 and 1.3. But at the end of the day, interest rates in my books, I mean, and here we get crossover into the work of John Williams, the shadow stats, and I mean, what is the real inflation rate? I'll tell you something very interesting. I was asked by somebody to make a contribution, a writing contribution about the effects of deflation on the housing market, in the near future. And like, I read this and I just thought to myself, what is this person talking about? Like, what planet are they from? I don't see any deflation anywhere. I mean, other than, yeah, big screen TVs don't go up in price every year, but everything else does. Like the cost of medical care, the cost of food, the cost of energy, the cost if you need a doctor, if you need a lawyer, if you want to go to school, any professional service. I haven't noticed one profession anywhere in the world lowering their rates. I mean, have you?
No, no, not at all.
In our lifetimes, Patrick, the U.S. dollar has been the global world reserve currency, where international accounts between countries were all settled in dollars. And primarily, the currency of the realm being the dollar, it's referred to as the petrodollar. And it's called the petrodollar because President Nixon took America off the gold standard in August of 1971. And what emerged in the aftermath of closing the gold window, where dollars were exchangeable at a rate of $35 for an ounce of gold, that was rebuked by Nixon in 1971. And what happened then was Henry Kissinger, a globalist of all globalists, he made a deal with the Saudi Arabians where they would sell their crude oil for nothing but dollars. And so that ushered in the era of the petrodollar, where the dollar sustenance came from the very fact that global crude oil trade all occurred in dollars. And that situation no longer exists, for one, because Saudi Arabia is selling factually is selling crude oil for other than dollars. And, for anybody who says that, Kirby, you don't know what you're talking about, Saudi Arabia only sells their crude oil for dollars. I'm just going to say, go look at their filings when they went public and look at their balance sheet. They've got a lot of euros on their balance sheet, and they have a lot of Chinese currency on their balance sheet, and they only have one product they sell. So how do they get the euros and get the Chinese currency on their balance sheet if they're only selling oil for dollars? So they are selling oil for other than dollars. And recently, we've seen the Saudi Arabians do a defense pact with Russia. And guess what that means, folks? Saudi Arabia is doing trade in more than euros, more than dollars, more than Chinese currency. They're probably buying or doing trade in Russian rubles as well at this point. So this whole myth about the dollar standard is basically gone by the wayside, as far as I'm concerned, because we have evidence, solid evidence, that trade settlement is occurring in other than dollars. I look at the daily turnover, something I follow quite closely, Patrick. The daily turnover in the cryptoverse. So this is all the cryptos all told together. And in recent weeks and months, I've noticed that the daily turnover in the cryptoverse is 150 billion, I'm going to say, on average. We've had days when it's been over 200 billion. We've had other days when it's been down around 100 billion. But I mean, I'm going to say probably a good average is probably somewhere around 150 billion a day. Well, if you annualize 150 billion in turnover a day, that gives you a number in excess of 50 trillion annualized. And 50 trillion in turnover is more than Joe Doakes trading with, Fred Flintstone. 50 trillion in turnover. Global GDP, Patrick, isn't 60 trillion, I don't believe. So if you've got a class or a group of assets called cryptos that are trading in excess of 50 trillion a year, I'm going to say that you necessarily have trade settlement occurring. So what I'm saying is there necessarily is trade settlement occurring right now in cryptos. And who's doing such a thing? Who would do such a thing? Well, how about countries that are energy rich like Iran and Venezuela? And China needs energy, and they're buying energy. They're buying energy from Iran. They're buying energy from Venezuela, and they're not paying for it in dollars. And how do I know that? Because Venezuela and Iran had been kicked out of a club called SWIFT. They can't settle dollars. Okay? But the oil continues to flow. So what do you think they're paying for the oil with? They're paying for the oil with cryptos. You see, and this circles back into the question you asked about bonds. Because, historically, the way the Petrodollar Standard worked is that countries sold their oil for dollars. They took their dollars that they received for the sale of their oil, and they parked the dollars in the U.S. bond market for safekeeping, and it earned a little bit of, earned them a little bit of return. And this is how the whole petrodollar system worked. That's been short-circuited. And countries that formerly sold their oil for dollars are no longer doing it. You see, this is, I call this a reduction in demand or need for dollars. So when you have a reduction in demand and need for dollars, what happens to the person who issues it? Well, they got to pay a little more, to keep people's attention or to make people interested in holding their currency. So that goes a long way to explaining why the bond market or the 10-year bond or the 10-year note has gone up in yield. And the reality is nobody's rolling in dough. The Western world, all governments are running massive, massive deficits. But it seems that the more debt they strap on, one would intuitively think, I believe, that this would make interest rates go up. But for the longest time, Patrick, they just haven't really wanted to go up. I don't know about you in Singapore, but here in Toronto, Canada, I can sure smell the waft of war in the air. And it sure seems like we're moving towards war, like in a pretty big way, globally. And isn't it interesting, Patrick? War is something that normally occurs when you transition from one exchange or means of exchange to another. The dollar is falling. We're stuck with what we have until it completely fails. And I think we're watching the slow motion train wreck of the dollar standard falling. We are watching that and living it out in real time right now. So then let's flip over to the work of Dr. Mark Skidmore. We know there's way more money being created than what is rationally explainable, because when you look at, for instance, the Fed's balance sheet in the last 18 months has gone from 3 and change trillion to 8.8 trillion. That's an uptick of 5 and change trillion in an 18-month period-ish, thereabouts. Well, look at Mark Skidmore's work. Mark Skidmore's work covers the Social Security Trust Administration. They have $400 billion in investable assets under that umbrella. It's all managed chiefly by Blackrock. Surprise! And that $400 billion in assets has a turnover in a year of in excess of $44 trillion. Well, if that isn't a big neon sign for fraud, I don't know what is. So Blackrock was formed in the aftermath of the 1987 stock market crash. Okay? And when the stock, and this is something near and dear to me because I worked in institutional markets, and I was working on a trading desk when the 1987 stock market crash occurred, and I know what happened in the aftermath of that was the formation of the President's Working Group on Financial Markets. Other people refer to it as the Plunge Protection Team. So we had the October 87 stock market crash. And the Plunge Protection Team was established in March of 1988, so 6 months after the stock market crash. And as far as I'm concerned, what BlackRock represents is the equity arm of the Exchange Stabilization Fund. And I've talked about the Exchange Stabilization Fund over many years in many interviews. And what the ESF is, which is the moniker for the Exchange Stabilization Fund, ESF. The ESF was created in 1934 after America confiscated gold from rank and file Americans. And what they did when they confiscated America's gold, they didn't actually completely confiscate it. But back in those days, the price of gold was officially $20 and change U.S. an ounce. And the U.S. Treasury called in all the gold in America and paid everyone $20 and change for it. And then 6 months after they collected all the gold from the citizenry, they revalued the gold up to $35 an ounce, and that created a windfall profit of $3 billion in 1934 dollars. And $3 billion in 1934 was a lot of money. And that $3 billion windfall profit was used as a seed money to create an entity called the Exchange Stabilization Fund. And the Exchange Stabilization Fund became, with the stroke of a pen, became the most powerful financial entity on the planet. And their mandate is pretty loosely defined as to ensure that the dollar remains a viable instrument in international trade. And so this dark entity called the Exchange Stabilization Fund, this is what manages our economy. This is what really manages our economy. I reckon the Exchange Stabilization Fund is responsible for this unbelievable amount of money that is, we have evidence of the turnover in the under the umbrella of the Social Security Trust Administration, which is managed largely by BlackRock. The BlackRock is managing the booty of the Exchange Stabilization Fund. Let's put it that way. So, and that's why the BlackRock managed entity called, let's just call it the Social Security Trust Administration. It's a slush fund. It's a slush fund where the unacknowledged money creation resides. It sits there, and BlackRock manages it for the U.S. government, or for the U.S. specifically for the U.S. Treasury. And the amount of money that's contained in there, based on the turnover that Dr. Mark Skidmore has identified and documented, my feeling is that the ESF could have much more money than U.S. government debt outstanding. U.S. government debt officially, publicly, is around $29 trillion. It wouldn't shock me in the least if the ESF had over $100 trillion of unacknowledged money residing in it. So what that means is, in theory, one could maybe take the leap and say the U.S. government, in theory, could retire all their outstanding debt with one fell swoop, because the money is there in the Exchange Stabilization Fund right now. The only problem with doing that is that if one were to acknowledge the existence of the money that I'm talking about or that I'm alluding to, the dollar would lose its position as the world reserve currency overnight. Nobody would take dollars. Nobody would take in the world would take dollars in exchange for anything if they realized that the amount of money that they believed was X was indeed 1,000X or 100X, because that would shock the world into realizing that the dollar's worthless. And if that occurs, the guys who've been playing God, ruling the world, using dollars to bribe and to coerce people around the world and to pay their military to do their dirty work, if that currency suddenly turned to confetti, they lose all their power. So they have a vested interest in not acknowledging or allowing us to realize or to publicly, they don't want what I'm saying to gain traction. They don't want people to realize that the amount of money in existence is far, far, far greater than what's acknowledged. So, and this plays back into the bond market. I mean, what's the appropriate interest rate for a 10-year U.S. government bond when the money supply is actually maybe 100x of what people believe it is? Well, you couldn't attach a high enough nominal rate to justify what I just laid out. I mean, if the amount of money in existence is many, many, many times what's acknowledged, then, we're in a state of hyperinflation. So what am I saying at the end of the day? The bond market's a mirage. And I guess really at the end of the day, Patrick, you want to know what I think of the U.S. bond market? The U.S. bond market is safe and effective. And that should resonate with people. You see, I used to live in a world where the stuff I say today, I used to live in a world where I would have laughed at me. 25 years ago, I would have laughed at me, what I'm saying right now. And I'm gobsmacked with what's occurred. I mean, I worked in institutional markets. I know the way they're supposed to work, and they're not working that way, not at all. And you can try to rationalize it or explain it any way you want, but this is reality. I live in the here and now. I try to, at least, and things are not as they're being reported. Let's put it that way.
Okay, Rob. So let me summarize some of that that was said there. So the U.S. dollar is losing or has lost its petrodollar status. Some oil-producing nations may be now using crypto to buy or sell their oil. BlackRock is holding Janet Yellen's booty, and the bonds need boosters. Are we caught up there?
Yeah. Why is there no transparency with the money? Why is there an Exchange Stabilization Fund? Why is it that the lion's share of the heavy lifting has to be done behind a black curtain?
Rob, what does the U.S. do at this point? I mean, do they go for broke and continue on with the same old, with increasing the money supply, increasing debt, weaponizing the dollar and the SWIFT system until the world says no more, basically challenging the world to say no more? When does the world actually say no more, and how are they going to say no more?
Well, the world, Patrick, the brutal reality is the world is doing it now. Okay, it's occurring right now because the petro trade or the petrodollar. Just understand, the U.S. dollar is referred to as the petrodollar, and we have two major petro players, be it or suppliers, Iran and Venezuela, that are currently not selling their product for dollars. Well, that's just think about it this way. That's the foundation for the dollar. Okay, that is the underlying foundation of the dollar. is the trade in oil. And two of the world's biggest oil players are not selling any of their oil for dollars. Let that sink in. China appears to have large amounts of U.S. government securities in their possession. But the reality with China is China recycles their dollars. And what China does is they go to countries in places like Africa and they buy infrastructure. They buy roads, they buy mines, they buy natural resources of different descriptions, whether it's food, whether it's minerals. And what they do is they say to these countries, we would like to purchase these raw materials from you. And they say, and they agree on a price. And so what does China do to basically give surety to their purchase? They pledge U.S. government debt as a collateral to take the natural resources of countries in far-flung places around the planet. So if you think about it this way, let's pretend you're a farmer, Patrick, and you're growing corn, and I say I want to buy your corn that you're going to produce, but I want to agree on a price today that I'm going to pay for it. I'm going to buy all of your corn for $2 a bushel, and you say to me, well, Rob, how do I know that you're good for buying all my corn at $2 a bushel? Because let's just say you plan on producing $3 million worth of corn from your land. And I say, well, I'm willing to pledge my $3 million worth of U.S. government securities that I will buy your corn from you. So if I don't actually buy the corn, you can have, the $3 million is yours. So then what do I do? In the meantime, what do I do? I'm servicing the debt. I'm probably going to pay interest if I've effectively, you're growing the corn. You need income. So I'm going to pay you a stipend probably every month, and you're going to promise me the corn. So then what happens? What happens after the harvest, when I've taken all your corn, and now it's time for me to pay in full for the full load, because I now have all your corn. And I say, well, Patrick, I agreed to pay $3 million, but I don't really have $3 million in liquid cash. So you can just take the bonds that I pledged as collateral. So you're a happy bond owner now, and I got the corn, or I got the road, or I got the toll road, or I've got the hard asset, and you got the bonds. Okay, but they appear in ledgerdom, for accounting purpose, it appears like China still has those bonds. But the reality is China's pledged those bonds to somebody else.
But, Rob, with those types of consequences, why doesn't the U.S. just perhaps offer maybe assets to back the dollar, or eventually maybe even reinstate a type of a gold standard?
Well, you see, somewhere along the line, Patrick, there's going to be a reconciliation. Somewhere along the line, and that's what that's probably America's biggest fear. At some point, the dollars they have are going to return home. America's biggest export is dollars, okay? A lot of people might think it's arms, and a lot of people might think it's technology. America's biggest export is dollars. And they've sent so many dollars to so many places around the world. Their biggest fear is one day those dollars come home, because people want something real and tangible for them. And when those dollars return home, what happens? You get a hyperinflation. And this goes a long way, at least in my books, to explaining why a company like Blackrock is buying up real estate. And it's documented that they're buying real estate. They're buying residential real estate. They're buying it hand over fist. Why? It goes back to they have too many dollars. They're managing too many dollars from the Exchange Stabilization Fund, which is money that's been created off book that isn't acknowledged to exist. I mean, if you go through the ownership of every listed company in America, and I don't care which company you're talking about, name a company. Everything from the defense industry to banking, pharma, BlackRock and Vanguard, they own at least 15% of every company on the planet. Whether it's Boeing, whether it's Novartis, whether it's JP Morgan, they own everything. And now they're buying up all the residential real estate. Like, do you really believe, Patrick, that all this money is coming from people saving out of their paychecks and investing with BlackRock? Like, really? This company's only been around since 1988. It's the biggest financial entity on the planet.
I wanted to ask you about BlackRock. They're buying up zip codes, basically collecting assets, and then you have central banks. They do hold, generally speaking, they hold gold in reserves. They all hold gold in reserves. And the question is, when that day of reckoning comes, will gold have a role to play? Will it come back into play once they try to reset currencies again?
Well, let's put it this way, Patrick. Every fiat currency ever created by man has ultimately gone to its true intrinsic value, which is zero. The dustbin of fiat currencies is very deep and very big, and every fiat currency ever devised by mankind has gone to zero. Precious metal has never gone to zero. Okay? Precious metal has been money for 5,000 years of recorded history. Let's put it this way. We know that man has been walking this earth for at least 5,000 years. We have evidence that says that's the case. And gold and silver has been money for all of that period of time. Never once has it gone to zero. But every fiat currency ever devised by mankind has gone to zero. In my books, the jury's out on whether cryptos might ever go to zero. I don't know whether they will or whether they won't. But let's just say gold and silver never have. I don't believe they ever will. So in my view, it would be pretty foolish to think that gold and silver aren't going to be money, or remain money in the future, because they have history on their side, and that's documentable. And I mean, when you think of treasure, what's the first thing that comes into your mind when you say treasure?
Think of gold and silver.
Silver, maybe diamonds, but treasure is gold and silver. Treasure is not a Bitcoin. Look, the books may get rewritten, and maybe at some point Bitcoin will be viewed as treasure. I mean, but classically, when you speak treasure to somebody, they think gold and silver. Why? Because they're time tested and they've never ever gone to zero. Okay? You might lose money trading gold, but gold never goes to zero. Silver never goes to zero. They have utility. They have use. They are universally understood to be a placeholder of value, and they've never gone to zero. How many .com stocks have gone to zero? How many cryptos are going to go to zero? There's thousands upon thousands of cryptos in the world. And how many of those are going to go to zero? I suspect a goodly portion of them will ultimately go to zero. But some will survive. Just like the .com era produced a lot of turkeys and a lot of things that failed. But out of that rubble came the likes of Amazon, the likes of Google, the likes of Facebook. So some have been resounding successes, but how many thousands failed? More than you can count. Cryptos will be the same, I believe. Some will be massive winners. Most will be abject failures. You know, in precious metal, they've never failed, ever. So it's sort of the rock in your investment portfolio. I mean, when choosing an asset mix, best you have something that's guaranteed to never fail. Because if everything else ends up failing, you'll still have something.
Yeah, it's a great point there, Rob. Appreciate that. Rob Kirby, before we wrap up, can you let our listeners know how they can follow you and contact you?
Well, you can catch me on the web at kirbyanalytics.com, and I do what I can, Patrick, in terms of trying to educate and have people understand a very, very complex and it's been made a lot more. Look, our financial world has been made a lot more complex than it needs to be. You know, at the end of the day, you know, what can you do with something called money? You can buy it, you can sell it, you can borrow it, and you can lend it. And, you know, buy, sell, borrow, lend are four pretty basic and easy to understand principles. Everything else that Wall Street and the bankers and the financial universe talks about, if you boil it down, it's buy, sell, borrow, or lend. And everything that occurs in our financial universe can be absolutely put into one of those three or four categories. Buy, sell, borrow, lend. That's all you can do with a financial asset. Plain and simple.
All right, Rob Kirby, that's some great advice there. Rob Kirby, we appreciate the time you've given, and I hope we can do this again soon, and hopefully things will unfold for the better.
Well, we can only hope.
That was Rob Kirby sharing his views on the economy. To follow Rob and his work, go to www.kirbyanalytics.com. If you like this video, please subscribe, share, and give it a thumbs up to let the algos know you approve and want more. Audio-only versions of this interview can be found on iTunes and Spotify.